Hey guys, welcome to the first module of our trading course. I'm super excited, super eager, and super stoked to be taking this journey with you. I can't wait for you guys to be advancing with me and learning how to trade stocks the right way. Now, this is the first module, so it's going to be a super quick video. I'm just going to be covering the course objectives and my teaching approach. Now, make sure to check for notes for each module that we have and to do the quizzes for each module. So really quickly, what is the course objectives for this course? Now, first of all, one of the objectives is for anybody who wants to become a day trader. So if you want to become a day trader, this is absolutely for you. So I've developed this course so that if you do want to get into this business, or if you're already trading but want to improve, be more consistent, this will help you get there. Okay. Another objective for this course is for you to be making better investment decisions. Not everybody wants to become a trader. Not everybody wants to do day trading. Some people want to do swing, but some people just want to invest. If you want to invest, it's also very important for you to understand the intricacies of trading and how really all aspects of trading and how that works to help you get good entries in your investments. And that can make a lot of difference, trust me. This course is also the first level of training for our traders. So all the traders that work here have actually went through this course, and that's how we hired them, right? So it is actually, a training module that we've set up for our traders before we hire them. So they're obliged to take it before getting a position here. We also use this course to scout for new talents. So every course, we're going to look at the traders. We're going to see if one of them looks promising. And if one of them does look promising, we'll invite them and bring them over to trade with us. Very competitive. We get a lot of applicants, but we do use this for scouting for new talent. We also give this course to prospective employees who aren't sure if they want to become traders or not, and they just want to discover the business, right? So before you want to jump into trading, if you have another job, if you're doing something else full time, don't jump into trading right away. Take this course, see how you like it. If you see you like it and this is something that you want to do for the rest of your life, then you might want to jump in. But don't jump in without really knowing what you're getting into, right? A lot of people have misconceptions about what it takes to become a profitable trader. It does involve work. It does involve you learning a lot of new things. So make sure you test the waters first, see if you really love it. And if so, then you can, leave the other things that you're doing and get into that. Now, really quickly about my teaching approach. Now, I've been in this business for a long time. I've seen a lot of really smart people not make money in trading. And I've seen a lot of people who aren't that smart, okay, make a killing in trading. So what is the difference? And I don't mean not smart, but I mean maybe not with a lot of degrees. So I've seen guys with double PhDs, maths, programmers, super smart, and they've never made a cent in trading. On the other hand, I've seen guys without a high school diploma who are consistently killing it and making a shitload of money. So what's the difference? It's not that the guy without the diploma knows more than the guy with the diploma. Obviously, the guy with the diploma knows more and has more discipline maybe in getting educated. But it doesn't necessarily mean he understands the concept that he's learned. He just knows them. Than the guy who doesn't have the proper education. So it's not really about how much you know. It's about your understanding of these concepts. So what I've decided is to really focus on the concepts that I found most important and the ones that made the difference between the people who are making money and the people who aren't making money, and focusing on those concepts and not just on knowing them, but on understanding, really the issues with them that make the difference and that could lead you to profitability. So really the course is very much based on understanding these concepts and not just throwing a bunch of information at you, asking you to learn them by heart, but really to understand why this happens and how to interpret different types of information under different circumstances. In this module, we're going to be talking about why be involved in the stock market. Now, there's two reasons to be involved in the stock market. Reason number one is going to be to trade/invest your money to generate income. Number two is going to be invest or trade other people's money to generate income. Now, In both situations, your main objective is to generate capital, to make money for yourself, right? So you can go about this in two ways, by trading your capital or trading somebody else's capital. Now, a lot of people trade their own capital, and they do that to either supplement their main income with a side income, or they just trade full time and that's their only income. Their main income is from trading. Now, I believe that everybody should be invested in stocks at one point or another. Like everybody at one point has to be invested in stocks. You know, when you're going to be saving up your retirement funds, your money is going to be in stocks in one way or another. Now, throughout my years and throughout my careers, I've worked at brokerage houses. I've seen a lot of accounts, people with, you know, $500,000 accounts that's for retirement, going from $500,000 to zero because they selected really bad stocks, all high risk, all same industry, gold miners or penny stocks. But I've seen other people going from $500,000 to over $1 million. So you can very easily, and you know, when you're saving up your money for retirement, that's done across decades, you know, 20, 30 years. When you're looking at such a big period, it's very easy to double your cash. It's very easy by selecting good stocks. Now, it's also very easy to lose most of your cash if you select really bad securities. So for me, everybody's supposed to learn about trading and about investing, because if you're willing to work 20, 30 years of your life to have X amount of capital that you can retire with, well, why not spend 6 months or a year learning how to invest and double that amount of capital? Why not double it by spending a few months to a year learning when it takes you 20 or 30 years to make it, right? And not risk losing it, right? So it makes no sense for somebody not to get educated about investing, because everybody has to invest at one point or another. Now, this is one way that you can go about it, investing your own capital. Now, the other way is finding other people that you can invest their capital or trade their capital. Now, to do that, first you got to be good, okay? So, example, there's a lot of companies that fund traders. Now, to get into a company like that, you got to prove that you're good. So, when I hire a trader, I want to see their track record. I want to see if they are performing well, if they are making cash. So, start off trading your account. And if you're performing good, if you have, you know, a year of track record to show, or even, you know, 8 months of, you know, consistent profitability, you can see a company, show them your track record, and they can fund you. They'll give you a funded account. Then you can trade with way bigger amounts of money and keep a percentage of those returns. So that's a very good situation to be in, because you have no risk in terms of capital, and you have very, very high rewards if you're performing good. So these are the two ways that you can make money in trading. You got to start off by trading your account, proving that you're good, and then you can move on to even trading other people's accounts. And regardless of what you want to do and what's your end goal, you have to learn to trade and invest, because it is something that is super important. It will make a difference for you, and you know you are going to have to do it at one day or another. Hey guys, in this module, we're going to be talking about something super simple. What's a stock? Now, a stock is basically just a security that signifies ownership in a corporation. So basically, by having stocks in a company, you have claim on that company's assets and earnings. So basically, their buildings, their equipment, and all the money they make, part of it is yours because you're partial owner of that company. So by having stocks in a company or shares, these are synonym words, stocks and shares, it's the same thing. So if you have shares in a company, you're basically partial owner of that company, and you have a claim on their assets and their earnings. Now, why would a corporation issue shares or stock? And why would somebody want to buy stocks in a corporation? Well, very simple. So imagine this. Imagine you're an entrepreneur, you like electronics, and let's say you sell drones, okay? You're making and selling drones. And you're selling drones to your family, your relatives, and in your community, and you're making good money doing that. Now, you think drones are going to be a big thing in the future, so you want to go global or even nationwide, right? So you want to sell way more across the globe. So what do? You need to open more stores, right? How would you do that? You need capital. Now, let me get on my whiteboard here. So imagine this. Imagine right now, this year, you were able to make $100,000 by selling drones in your community, right? Now, you're 100% owner of your company. This is your company, and let's say we're going to call it DRN for drone. So you're 100% owner of this company, which makes $100,000. Now, you want to go nationwide, open stores everywhere, okay? Let's say you want to open 5 stores, and each store that you're going to open is going to cost you about $1 million, okay? So it's super expensive having drone stores. Again, this is just an example. Numbers don't need to make sense. So where are you going to get $5 million? You can't collect $5 million by making $100,000 a year. It's going to take you way too long. So you need investors to give you that money, right? So what you're going to do is you're going to sell shares, sell stock in your company for them to give you the cash that you require. So if you require $5 million in total to open these stores, you're going to tell investors, look, I'll give you part of my company. I'll give you shares in my company. And let's say you give them 50%. Okay. So maybe you're going to give them 50% of your company. So they give you $5 million for you to open all those stores. And by you having all those stores, you're going to be able to make way more money. Okay. So let's say with 5 stores, you can make $2 million every single year. Okay. So even though you only own 50% of your company right now, that 50% is worth way much more because you make way more money now. So that 50% you're still gonna make $1 million every year in comparison to only $100,000 every year. So even though you have less shares in your company, you're able to make way more money because your company is way bigger, right? So this pie here is way bigger than this pie, okay? So it's actually a very good idea to sell shares in your company when you want to grow your company and you need the capital. If you don't want to grow organically, because that might take too long, right? So why would a corporation issue stock? Because they want to grow. They need the capital to expand, and they're willing to sell part of their company to you to get that capital. Now, why would an investor want to buy shares in a company? Again, very easily, to participate in the growth of that company, because that person who's investing will own part of the company. So they'll participate in the growth of the company and make money through their earnings and their growth, but without even putting in work, just by owning the shares, right? So somebody else is going to be doing the work and they're going to be collecting money. Now, for traders, what we want to do is we want to look for mispricing in the price of a stock, because again, when we buy or sell a stock, it has a price. If we can evaluate at what point that price is too high or too low, and we find the mispricing, we can take advantage of it and profit off that mispricing. So this is really why you would want to companies issue shares, and why investors or traders would want to buy shares in a company. Now, let me just open this real quick here. Now, how can you buy a stock? What do you do to buy a stock? Now, there's 2 ways to buy a stock, and it depends if a stock is private or if the company that you're buying is public. Now, how and where can you buy stock? Well, it depends. If you want to buy stocks in a private company or if you want to buy stocks in a public company. Now, what's a private and what's a public company? A private company is basically a company that has a relatively small amount of owners and that doesn't trade on a public exchange. A public company is a big company that trades on one of the public exchanges. So when we're talking about Apple, Amazon, Netflix, all these big companies, Facebook, they're public companies. Now, before they were public companies, they were private companies. They were smaller companies at one point that didn't trade on an exchange, okay? So in the same example that we were talking about, where if you wanted to open a drone company, initially it would be a private company, right? You would have a few investors and that's it. It wouldn't be public. Then there's a process for a private company to go public, which we'll cover in a later module. But this is what you need to know about that for now. So you can't just walk down the street and see a restaurant that somebody opens and invest in it, right? Because any restaurant, that's a private company. If somebody has a store, it's their private company. You can't just walk in and say, hey, I'm buying shares in that company. To be able to buy shares in a private company, you got to know the owner. You got to be either a friend or relative of the owner or somebody who works there, or you got to be a qualified investor. So you got to have a lot of cash. You got to be rich. And that's the only way that you're allowed to invest in a private company. So it's not easy to invest in private companies. And because of that, it's not easy for private companies to get funds when they need, right? Because they got to know somebody who's going to be able to give them the funds, or they got to know some people who have a lot of money. Now, public companies, on the other hand, anybody can invest in them. It doesn't matter how much money you have. You don't need to know the owner. You don't need to know anybody at the company. You can just call your broker, call the bank, tell them, hey, I want to buy shares in Facebook, and that's it. You got your shares. So there's a very big difference in private companies and public companies. When we're talking about buying and selling stocks, we're only talking about public companies because these are the only shares and stock that we can buy. And that's the only stocks that trade on exchanges. Private companies don't trade on exchanges. And again, if you want to invest in a private company, you got to either know the owners, somebody who works there, or you got to be a qualified investor. A qualified investor means that you make, and it depends, each state and each country is different. But let's say, for example, in Canada, you got to be making more than I think either between $200,000 or $400,000 every year for the past 3 years, and you got to have more than $2 million worth of assets under your name. So you got to be rich enough that you're financially savvy to be able to understand how private companies work. Again, so private companies, very hard to buy shares in, but public company, extremely easy. And that's what we're going to be looking at in this course. Hey guys, in this module, we're going to be covering what's a market. Everybody knows what a market is, right? We go to markets every single day. A market is basically just a location where you go to buy and sell products. It's a location where people go to do commerce. Now, there's a lot of different types of markets. There's clothing markets, there's electronic markets, there's grocery markets. So markets are characterized by the product that they specialize in, right? So there are markets that are more general where you can buy and sell different things, but some markets are very specific where they only deal in one type of product. Now, we're used to one type of market. The market we're used to is a market where we go, the prices are already set, and we can either accept them or refuse them. Example, when you go to a grocery store, apples might be at $2 a pound. You can either accept that price or leave. You can't say, no, I want to get it for cheaper. You can't bargain. So that's the regular type of markets that we're used to. Now, there's another type of market, and that market is called an auction market. An auction market is a market where buyers can compete on the bids that they're willing to pay for a product, and sellers can compete on the offers that they're willing to sell that product for. Imagine this. Imagine if you went to a grocery store and instead of having apples at a set price, in a basket, you had 20 different people, and every person in that group held an apple and was saying, I'm willing to sell it for, $2. And the other person might say, I'm willing to sell my apple for $1.90. Somebody else for $1.85. So every single seller would be competing on what price they're willing to offer you the apple. And then all the buyers, instead of just accepting or not, they come out and say, well, I want to buy an apple for $1. And somebody else might say, I want to buy an apple for $1.10. So all the buyers are also simultaneously competing on the bid prices that they're willing to pay for that apple. So obviously that would never work in a grocery store or in the type of markets that we go to. But that's exactly how the stock market works. It's an auction market. There's no set prices. Buyers are bidding for the best price that they're willing to pay for that stock, for that product, and sellers are offering, how much they're willing to sell their product, their stock, and it's all going on simultaneously and continuously throughout the trading day. And that's how prices are set. Now, that's what a stock market is. So we're going to be focusing on that, obviously, throughout this course. Now, there's two types of markets. There's the primary market and there's the secondary market. Now, what is the primary market? The primary market is the market that the stocks trade in for the first time ever. So the first time that a stock is issued, goes out to the public, that's the primary market. Secondary market is every other time it trades after that. So it's basically second hand. Every time the stock has been traded second hand, somebody already owned it before you, you're in the secondary market. Now, the way it works is when a company is private, and again, let's go back to our example where we said you opened a drone company. And let me get on my whiteboard here. Okay, here we go. If you open a drone company and you've decided that, okay, you had your initial drone company that was making about 100K a year, and then you went private, right? And you got $5 million of revenue to open a way bigger company, okay? That was making about $2 million every year. Now imagine you want to go one step further. You want to grow your company even more. So you want to go public, right? You want to go from private to public. So you get a way bigger company. Now, if you want to go public, what you're going to have to do is you're going to have to get funded. You're going to have to do an IPO, which is what we call, okay, an IPO. I'll put it here. IPO, which is initial public offering. And this should be in the notes for this module, right? So you got to do an initial public offering. Initial public offering means you're going to sell the stocks from your company to the public for the first time ever. So out of this company that you have and you own with investors, you guys might sell, part of it to the public, okay? And the public is going to pay you for it, so you can have an even bigger pie and even grow more, right? So now, how do you do an IPO? You got to hire another company, which is going to be called an underwriting firm. So underwriting firms basically specialize in doing IPOs. So they're going to come in, they're going to see you, they're going to look at your company, they'll tell you, okay, you're making $2 million in revenue. This is the plans that you have. You want to expand here, there, you want this amount of money, you have this much debt, your product sells for that price. Okay, we can probably get you $100 million. So they're going to figure out how much they can get you through an IPO, and they're going to figure out what's the best price that they can sell your stocks at in the beginning, for them to be able to sell you the amount of shares that you want to sell, right? So they're experts in that. And obviously, that company is going to want to give you the best amount of money that you can come up with without asking for too much. Because if they ask for too much and your IPO fails, you're not able to get that money, then they're going to have a really bad reputation. So for them, they want to get you the most money. At the same time, they want to be able to sell all the shares so they maintain their reputation. So it's very important for them to come up with an exact price and an exact amount of money that they can come up with for you, right? So in this case, they might say, okay, well, we think we can raise you $100 million, 100 million, okay? We're going to sell 1 million shares, okay, at $100 each. So we're going to IPO at a price of $100 and we're going to sell 1 million shares, so you get your $100 million. That's what they're going to do. So once they decide to sell those million shares, that's going to happen in the primary market. So this company, the underwriting firm, is going to call all their relationships, their brokers, the banks, big insurance companies that they know and they have a relationship with, and they're going to call them. They're going to tell them, hey, look, I have this new company. It's called DRN. They make really good drones, and they're going to be a really good company. I have some shares I can give you, 100,000 shares in it. Do you want some? I'll allocate you some shares for that IPO. And they're going to sell those shares to all their relationships, and that's going to be the first time that the shares are sold, which is going to be in the primary market. So those companies, the brokers, everybody who gets shares can give some of those shares to their biggest clients. So if you're a very big client at a big brokerage firm, you might get some shares of that company. Example, when Snapchat or Facebook went public, and they went, from here to here, who could get the IPO price? Who could buy at the primary market? Very few people. We couldn't get any. A lot of people couldn't get any because you had to be a very big client of a very big firm to be able to get some of those shares because they're so hard to get by, right? So we rarely trade in the primary market. We rarely get shares in the primary market because it's so hard. You got to be somebody very, very big to get shares in the primary market. Now, after those shares are sold in the primary market, then there's a date where the stock starts trading on the exchanges, which we're going to come to in the next module. But then when these shares start trading in that exchange, they start trading in the secondary market. So whenever you or I buy something on NASDAQ, New York Stock Exchange, that's all secondhand. These stocks were already sold. They already IPO'd. They're in the secondary market now. We're selling them and buying them from other people who had them. We're not the first people to get them ever. When you're the first person to get the shares ever, you've got them in the primary market. When you're not the first person to get them, it's secondhand, you're in the secondary market. So we're always going to be talking about the secondary market when we're buying and selling securities because we're not the first people to get them, right? Hey guys, in this module, we're going to be covering what's an exchange. Now, we've already talked about markets. A market is a general term that relates to where stocks are trading. Now, when we're talking about exchanges, we're actually talking about the exact location where the trades are being executed. So imagine this. When I say grocery stores, I'm talking about markets. If I go and say the specific store exactly, meaning, Whole Foods or Walmart, these are exchanges. So both of these exchanges where you can go buy food from are grocery stores, which is the market. So same thing with stocks. You have the stock market, but within the stock market, you have different exchanges that you can go to. So different stores, physical locations that you can go buy and sell stocks from. So New York Stock Exchange is an exchange. It's a location that you can go to buy and sell stocks. NASDAQ is another location where you can go and buy stocks. They're both stock markets, but they're different exchanges, right? So just so you understand, I'm going to give a brief history lesson, if you want to call it, for how stock exchanges were born. So initially, back in the time, let's say in the 1700s, almost 1800s, when you wanted to buy or sell a stock, you would have to find somebody who wanted to buy or sell that same stock from you at the exact prices that you were willing to buy or sell it at. So if you wanted to buy 100 shares of General Electrics, you had to find somebody who wanted to sell his shares of General Electrics. And you want to find somebody who wants to sell them at the price that you're willing to buy them from him. So it wasn't easy. People back then would have to put it in the journal or try and find somebody on the streets, ask around. It wasn't simple. You didn't have a computer where you can just put it in and you match with somebody else. So it was a bit of a hassle. So what people used to do back then, they would meet. There were these regular meetups that people would have in the town halls and in the centers of the city. And they would meet and they would trade stocks with one another. So one of those locations was in New York. People would meet there every Thursday, either at noon or at 2 p.m., something like that. They would meet every week. And these were groups of financially savvy people. They had stocks in different companies. And they would like to meet so they can buy and sell those stocks with one another easily instead of going through the hassle of trying to find a counterparty. Now, this became very popular and a lot of people started meeting with them. And that specific group that was in New York started growing bigger and bigger and bigger as more and more people started to come on that day to trade the stocks. Then they started meeting more than once a week, then more than twice a week. So what happened is a group of these traders who actually started this, who were meeting there first before everybody else came, started to see that it became a hassle dealing with so many people. There were too many people coming around. So they decided to meet and sign an agreement with one another called the Buttonwood Agreement. Now, they called it the Buttonwood Agreement because the meetup was always underneath a tree called the Buttonwood tree. I don't know why it's called that. And in that agreement, it said, we're not going to trade stocks with anybody else but ourselves. Okay? There were 24 guys. We're only going to trade with ourselves. And if somebody else wants to buy or sell stocks from us, we're going to charge him a commission of 0.25%. So that's how we're going to do it. So that way it stops becoming as hectic and we can profit off of them. And then we know everybody's going to have to buy and sell stocks from us because we have the most stocks and we're a group of people that are going to have the majority of the stocks at this location. So people had to go through them. Now that worked out very well for them. They moved from under the tree to the coffee shop next door. And again, that agreement was made in the 1792. That's when they signed it up. And just a year later, they moved from that coffee shop and they bought the building right in front, which is what is now known as the New York Stock Exchange. So that's how the New York Stock Exchange was born. And these 24 people were the 24 original brokers. And again, there's going to be another module about what a broker is. But a broker is somebody who you have to go through to buy or sell the security. And these were the 24 original brokers. And they hold through this day. There's more brokers, obviously, but that's the same concept works where you get to call your broker and he buys it and sells it for you. So people would have to go see them and they would either buy or sell the stocks for that person with another broker. Now today, there's three main exchanges that exist. There's the New York Stock Exchange, there's NASDAQ, and there's Amex. New York Stock Exchange is the biggest and most demanding exchange. Now, the way you got to see it is an exchange is like a store. And to have your product in a store, the store has to accept having it. Same thing with exchanges. If you want your stock to trade at an exchange, you have to go ask the exchange for your product to be listed on that exchange. So if Snapchat wants to be on an exchange, they gotta go ask the exchange. And if they go see New York and tell them, hey, can we put our stocks on your shelves so people can come and buy and sell it here on this exchange? New York has to accept them. Now, New York is a very demanding store. It's a very demanding exchange. They have the most demanding criteria out of all the exchanges. So you got to be a really big, and when I say demanding, it means they're looking at the size of your company. You got to have a big company. You got to have a minimum amount of employees. Your price has to be over a certain price. Your stock has to trade over a certain amount of times every day. So they have criteria. Now, the second exchange is NASDAQ. NASDAQ is less demanding, is very known for having tech companies. So most tech companies are on the NASDAQ exchange. Now, different stocks trade on different exchanges. They don't trade on all the exchanges. Again, it's like having an iPhone. If you want to buy an iPhone, you can't go to Walmart to buy it, maybe. But you can go to the iPhone store to buy it. So you can buy it from that store. Same thing with stocks. You can buy different companies at different exchanges. Some companies very rarely are intra-listed on more than one exchange, but mostly they're going to be on one exchange. So when somebody tells you, hey, where's the stock trading at? It's trading on New York or it's trading on NASDAQ. They're talking about which store is it trading at? Where do I have to go if I want to buy it? This store or that store? Now, the third exchange is Amex. Amex is an exchange that caters to ETFs, exchange traded funds. Now, ETFs is something we're going to get into in another course, in another module, but most ETFs are going to be on the Amex exchange. So these are the three exchanges that you need to get familiar with for all the stocks that trade in the United States. Now, different countries are going to have different exchanges that you're going to have to look up. Hey guys, in this module, we're going to be covering what's a broker. Now, we've already talked about this in the other module. A broker is somebody who you're going to have to go through to buy or sell a stock. So when you want to buy a stock, you got to call your broker, let him know what stock you want to buy, and he's going to have to go and see if another broker's client wants to sell the stock that you want to buy, and if your prices match, so you guys can transact with one another. Now, we've talked in the other module about how brokers were born. Now, initially, if you wanted to buy a stock, you would have to contact your broker either through mail, and then with the advent of the telephone, by telephone. So you would call your broker, and then he would find your counterpart. Now, brokers, as they became more and more busy, hired floor brokers. So they hired another person that would go out on the floor of the exchange, run, and you know when you see in movies people screaming at the top of their lungs, I want to buy 100 shares of, GE at, $100, $101. These were, the floor brokers that were acting on behalf of clients, trying to buy them the shares. And if another one that wanted to sell at the same price matched with them, then there would be an execution, and you would have your stock. Now, back then, it would take a lot of time for you to get your trade. It took a few minutes before the broker would have time to get there, contact his other floor broker finds your match, signs it, and gets you the trade. Now, it's still the same structure. It just got way faster. With time, it got automated, so you could enter your orders, what you want to buy, through a computer, and the computer would send your order directly to the exchange, and then your broker would get it there. Now, with time, brokers didn't have to be on the floor anymore because there's a matching system, a computer on the exchange that receives automatically your order. And if there's another order that matches with it, the executions happen instantaneously. You still have to go through your broker, so you still got to call your bank, who's going to be your broker, and tell them I want to buy this. Or you can even send it online, but it still goes through your broker and it goes to the exchange where it's matched right away. So even though the same structure exists, it's way more automated because the human intermediary has been removed and it's been automated right now. But you still got to go through your broker. You still got to pay that commission to them for them to route your order there and do the other paperwork.